Okay, so we continue lecture number 2. Lecture number 2. All right, guys, lecture begin. Lecture number 2, financial management. We continue with chapter 2, page 27. So, we got lecture 2, chapter 2. Page 27, and page 27 is financial statements and reports. Fundamental to finance is understanding financial statements and understanding reports. Basically, you need to be able to read and understand the meaning of financial statements. And financial statements will have, first and foremost, begin with the annual report. Annual report. Let me write it in red. An annual report is the big, full, complete document that corporations must report with, usually with the regulator. And the report's got 2 sections. First one is verbal. In the verbal section usually provides analysis of what happened. It provides explanations in simple, easy terms so that non-sophisticated investors can actually understand. It provides an explanation for how the firm performed, what kind of profits they made, what was unusual, what was extraordinary, and an important piece of that report is the future, the expectations, the forecast, the future risks, the future challenges. Now, these are words, and many investors don't believe them, don't trust them. CEOs and corporations lie and cheat. That's their business. They lie and cheat on financial reports and statements in order to make things look better, in order to boost their stock price so that they can cash in their options and make usually millions out of them. So investors rely first and foremost on financial statements. Financial statements. And financial statements provide accounting information which must be, here's the key, audited. Guys, you guys get warning, okay? Next time you're out, okay? If you want to be sure, just move to the front desk to avoid, okay? Be smart, move up front. Information has to be audited. And an audit is a review of the accounting statements by a professional auditing company which certifies that the statements are true and correct and that they're not by nature misleading. So, financial statement must be auditing, and auditing provides what's called credibility. Because the auditor is independent, it provides a dose of trust, of trustworthiness. So, we're back to financial statements. You got 4. And let's see which one they have first. Balance sheet. Yes. And the first one is simply the balance sheet. And balance sheet tells you the financial position of the enterprise. It tells you at one particular moment how much or what kind of assets the company has, and what kind of liabilities it has, and what's the equity. That's it. It tells you all assets, and then all liability, and all equity. That's the balance sheet. The next one is income statement. And the income statement tells you whether the company generates profits. Now, we have the word income, and income is extremely difficult and tricky because, gross income, net income, after-tax income. So income has a lot of different forms and variation. But the main one is the one that we like to use in economics and finance, simply called profit. The income statement basically tells you, is the corporation profitable or not profitable? Is it generating profit or not generating profit? And the income statement, which, as I say, is, reports profit, simply tells you and lists major revenues and expenses. That's it. Provides, it's a statement of all revenues, all expenses, and gives you what accountants usually would call net income. And net income will be the modern day equivalent of profits. When expenses exceed revenues, in other words, you spend more than you got, net income is usually called net loss. Net loss. And in finance, we just call it loss. Okay? That's the reason why the income statement is sometimes called, and in finance they just call it profit and loss statement. So, profit and loss statement is exactly the same as income statement. Okay? Profit and loss statement is more like the old term from 50, from 100 years ago. It's simply a statement which tells you about the profits, or if the company has losses, by listing the revenues, expenses, and providing you with the difference. Next one is called 3, statement of cash flow. Well, that one is fairly straightforward. In finance, let's call it modern finance, the most important thing is cash and cash flow. Whatever the profit is, the question is, do you get cash that you can spend? Do you have the cash that you can actually distribute to dividends? Okay? If you're manufacturing tables, sometimes it's not appropriate to distribute to your stockholders tables or chairs. Investors don't want tables or chairs or watches. They want cash. They want money. And therefore, statement of cash flow tells you just that. Is the corporation generating cash? So here, this tells you profit, the ability to generate profit. The statement of cash flow tells you the ability to generate cash. You may have cases where a corporation makes huge profits but doesn't generate enough cash. And you need to understand why. How do we explain the difference? Sometimes huge profit with little cash means accounting fraud. They're lying and cheating. Or it may be explained with good growth. I'll be talking probably 2 hours from now, 2 lectures from now about it in more details. So, a negative cash flow means they aren't doing really well, but it could mean the company is growing so fast that it's eating up all of its cash flow for new investments. I'll be explaining more down the road. This is just a simple introduction. And the last piece is statement of stockholders' equity. Well, that's a little tricky one because I'm teaching the accounting course, and in the accounting course we have statement of retained earnings. Earnings is plural, okay? Oh yeah, talking about earnings. Income statement, also called profits and loss statement, and income is sometimes referred to as earnings. So, earnings is typically a substitute for income and a substitute for profit. Okay? So, statement of retained earnings is basically what happened to retained earnings. And retained earnings is, as I've been explaining before, profit which is not distributed to investors as dividends, but instead is reinvested in the business. So, retained earnings provides the most important source of financing for the corporation's growth. And this particular source of financing is called internal financing. All right, 5-minute side explanation. Topic of financing. Which of course is a favorite topic to put on an exam. What does it mean to finance? To finance. As a verb means to raise funds, to raise money. And to finance is usually associated with issuing stocks, issuing bonds, or issuing other, we call them now liabilities, other financial instruments, so that a business or a corporation raises money. So, to finance means to raise money by issuing debt or equity. That's it. That's to finance. And financing is basically the same thing as source of funds. So let's write it out. Financing is the same as funding is the same as source of funds. So, you have two fundamental forms of financing. In finance, for anything, for anybody, internal financing and external financing. This little sign is called tilde, means same as above. So, external financing. Okay? So, explaining now. External financing is you sell bond and investors give you cash. So, you raise cash from investors. Okay? So, external financing always comes from investors. Investors is the source of financing. In other words, investors will give you money and you'll give them back promise to pay back in the future. Promise could be commercial paper, it could be bond, or it could be stock, where you promise that you will be sharing with them future profits. Okay? And internal financing comes from operations. Okay, let me do this again. From operations. This is the same as saying it comes from the business itself. And it comes from profits. Okay? So basically it comes from profits. Profits which you take and reinvest in the business. Well, that's internal financing. Is the same as statement of retained earnings. Now we are back to statement of stockholder equity. Statement of stockholder equity tells you about all additions and subtraction in equity of the business, of stockholder equity. Now, stockholder equity we commonly call capital. Capital. We commonly call capital, and we also like simply to shorten it as equity. So in accounting and very often in finance, when we say capital, it definitely means stockholder equity. Now, let me repeat from last time. Before, when we say capital, we mean instruments that mature in more than 1 year. That makes the word capital extremely difficult and the most confusing word in finance. The reason it has 5 major, fundamental, completely different meanings, and people confuse one meaning of capital with a different meaning of capital, a third meaning of capital. So one way around the problem of capital is you simply don't use the word capital alone. Okay? Instead of capital, you say equity here. There, you say capital markets. When you say capital markets, there is no confusion. This is the market for long-term financial instruments. Okay? So, stockholder equity, capital. Again, back to stockholder equity. It tells you all the additions and subtractions of the equity. That's it. You want to see what happened with the owners. You want to see what happened with the investors. Okay? And the statement of retained earnings is the biggest and most important part of equity. It's actually a sub-part, a portion of equity. Tells you, specifically zoom in on the reinvestment. In other words, it tells you about the growth. It tells you about how much the firm is generating, and out of these profits, how much it is reinvested for the firm to grow. Okay? So that's the statement of retained earnings. More coming later. Let's see what we have. Oh, so why do we need financial statement? That's on page 28 in the middle. It says we need it so that investors can make investment decisions to buy or not to buy the stock, to sell the stock, to make a loan. So, financial statements are used by investors to make financial decisions such as lending in investing. That's it. And they're used to forecast the future prospects of the company. So you use it for forecasting. So number one use is forecasting, and the number two use is financial decisions. All right, one other explanation. All of this type of accounting, all of this type of particular accounting, which generates financial statement, is called financial accounting. And financial accounting is accounting which is designed to provide standard and reliable accounting information to outsiders, to outside parties. Which are these outsiders? Number one, creditors, whether to lend money or not. Investors, whether to buy or sell stock. And number three, governments, possibly for tax purposes. All right? So, that field of accounting which satisfies people outside the company is called financial accounting. And financial accounting is made for financial decisions by outsiders. Financial decisions that are used only for insiders, we call them managers, has a separate branch of accounting called managerial accounting. Managerial accounting provides information which is needed by managers to make, we call them now internal financial decisions or managerial financial decisions. And it's called, let me write it out, managerial accounting. Right now, and usually for the rest of this course, and usually investments, is focused entirely on financial accounting and financial reports and financial statements. Okay, we are not concerned with managerial accounting at all. Okay, the managerial accounting is part of management. Those who study management, those who study MBA, those who study business, not those who study finance. Those who study finance focus on financial accounting. All right, let's see what else we have. Okay, information. All right, well, balance sheets. Let's move on to section 2.2. That's on page 29. And as I already explained, balance sheet simply tells you the assets and liabilities of a company. We call this the financial position. It provides you or gives you information for all the assets of the corporation and the claims against those assets. Who claims what? Those claims we call liabilities. Okay? Whatever is left not claimed by creditors and liabilities is left for investors. We call it equity. All right. Assets go into current assets. I remember like back in the old days, 20, 30 years ago, they often or sometimes called them short-term. And short-term asset mean asset which will be, well, which we expect to convert into cash within 1 year. Now, converting to cash is called liquidity. Converting to cash, an asset to cash is called liquidity, and assets on the balance sheet are ordered by liquidity. You always begin with the most liquid and then go down the road to the least liquid. And you have clear rules as to what usually is more and what usually is less liquid. But on the balance sheet, you're expected them to report them according to your particular liquidity. So, we begin, let's see if that's what the textbook does. Oh, wow. A balance sheet equation. All right, let's see what they have over here. Long term. That's confusing because it's got different names. The most common name for long-term assets is fixed. So, let me put in here, short-term assets stands the same for current assets. Long-term assets we'll call usually fixed assets. And fixed assets is exactly the same as long-term assets. You can choose to use whichever you like. It's your own preference. And some call it property, plant, and equipment. Property, plant, and equipment is another name. Sometimes property, plant, and equipment will be a separate item within the long-term assets. I'll probably be coming next lecture to explain this in detail. Now, let me see what else we have. Okay, assets. Let's do this. Let me write this in blue. Are further divided into tangible and intangible. Tangible asset is an asset which actually you can touch, feel, see. It has material presence. Table, books, chairs, computers, and all the other stuff. Intangible assets, when they come, have no material appearance. They are more of legal type, like patents, trademarks, and so on. I'm going to cover them a little later. All right. Stockholder equity. Itself, as I've already explained, has two separate components. And the first component is called paid-in capital. And the second is already discussed, retained earnings. So, paid-in capital is money raised from investors. That kind of money we call funds. So, paid-in capital is funds, usually in the form of cash, raised from investors, most often by selling stock. So, paid-in capital is a simple transaction between the corporation and investors. Corporation gives them a piece of paper called share. An investor gives them a piece of paper called money, cash. Okay? So it's an exchange of cash for stock. It could be done at the beginning when the corporation is first established. It could be done at any other time later. Any time during its life, the corporation may decide to raise more capital by issuing extra, or we call it additional stock. Okay? So that's paid-in capital. Whatever was contributed by investors. Well, that's how you know. When you say, oh, the corporation has $100 million of equity, but then the question is, well, how much was given by corporation? By investors, and how much? So if they have 500 and investors paid in 450 and the retained earnings were 50, they said, wow, investors put in a ton of money and the corporation earned and accumulated little. So if this is the retained earnings for many years of operations, that's not really good. It's actually really, really bad. Usually, a corporation that's lived for 20, 30, 50 years, most of its capital will be coming from retained earnings and very little will be capital coming from investors. So, it basically tells you how much was, again, paid-in capital represents external financing and retained earnings represents internal financing. So, what percentage of capital was financed externally versus financed internally? That's it. Let's take a 10-minute break, right? And continue next lecture in 10 minutes, right? Okay.